Friends, welcome again. So we were learning the concepts of cost of equity. Let us continue with that. Going to share my screen. Yes, these are various methods of computation of cost of equity, which I had talked about in a previous class. And you have learned that if there is no growth in dividend and you are following the dividend calculation model, the cost of equity is equal to D1 by P0. And if some growth is involved, the formula will be D1 by P0 plus G. This is what we have learned. And if there is some issue cost that needs to be netted off from the price, when we are solving this question, we have seen that price is 100, but there is issue cost of 5. So effectively price became 95, 100 minus 5. This question we have solved. Now, at this stage, very quickly, let us learn. As you know, now the formula starts D1 by P0 plus G. So let us learn uh, the concept of G, or the concept of growth, how it is computed. So on your screen, you can see there are three ways of computation of this growth rate. One is simple average past growth rate. Past growth rate, we'll find it out and we'll average it out. Second is the point-to-point movement in dividend, by seeing how dividend is moving from one point to another point, we'll be able to compute the growth rate. Third is that B into R, where B stands for retention ratio or R stands for return on equity. So retention ratio multiplied with return on equity will be able to compute growth rate. All these things we'll be discussing one by one. First, let us see what is this simple average past growth. Very simple. If you read this slide, you yourself will be able to understand it. For example, it says if the growth rate in the past 3 years are 10%, 12%, 17%, then the simple average will be the average of 10 plus 12 plus 7, 10 by 3. It is 13%. You can say that is the growth. So if you know the yearly growth rate on year on year basis, what is the growth rate? If you know, we can average it out. We can find out this is a simple average growth rate. Very simple. Okay. Next. Next is about the point-to-point growth. What we will be doing? First, we'll see the point-to-point movement in dividend. You look at this example. Example is saying dividend in past 5 years ago was 10 rupees. And today it is 20 rupees. So 10 rupees was 5 years back. Today it is 20 rupees. So it has moved from 10 to 20. This is, you can say 10 to 20 does not mean that it has doubled 100% growth and yearly growth divided by 5, 20%. That is 100 divided by 5, 20% growth on annual basis. No, it is not calculated like this. 10 to 20, it has grown. How you'll be computing the growth rate here? You see, that means if rupees 10 is invested today, after 5 years, it has become 20. It is going to become 20. That is the concept. Okay, that means if you are giving 20 rupees, 10 rupees today, you'll be getting 20 rupees after 5 years. So your inflow is 20, but your outflow is 10. You're giving 10 rupees and getting 20 rupees after 5 years. So what is the rate of return? Okay, so if you compute this inflow outflow ratio, inflow is 20, you are getting 20, but you're investing 10. It comes to 2.0. This 2.0 is referred to as future value factor. Okay, that means your investment is 10. If you multiply it with 2.0, it will become 20. So to convert your present value to future value, you have to multiply it with 2 or 2.000. So this is the future value factor. If you multiply your outflows with this factor, you'll be getting future. Now we'll be referring to future value factor table for 5 years. We'll see where this 2 is coming. Okay. And after that, we'll be deciding that what is the, I will find out that uh, this corresponds to what percentage. That percentage will be your growth rate. Now you have no 20 by 10 is equal to 2. Let me take you to the future value table, and now you search for future value factor plus for 5 years. Let me share my screen again. This future value factor table is also shared with you. Now I'm again showing you. If you look at your screen, you can see, let me take you which table is this. Yeah, this is the future value factor of a lump sum. And we are interested to know it for 5 years. Here I'm selecting the period is 5. So I'm selecting this thing. Okay, this is the row. And here you have to see 2.0. 2.0 comes to roughly here. You can see 2.011. Before that is 1.925. So it is close to 2.011. And if you see this 2.011 corresponds to 15%. Now you can say growth rate is 15%. Okay. Growth rate is 15%. This is how it is computed. So it is not straightaway 100%, not 20%, it is 15%. This is one more way of computation of growth. Third way, G is equal to B into R, where G is the growth rate, B is the retention ratio. Retention ratio means suppose company is earning some profit. It distributes some profit and it retains some profit. Suppose you are earning 100 rupees. You are distributing by dividend 40 rupees and retaining 60 rupees. That means your retention ratio is 60%. And the company will grow because of your retention. That retention money will grow. Return of equity means the return you're expecting from equity. So if you know your retention ratio, if you know your return on equity, you'll be able to compute the growth. Okay, let us say in this example, a return on equity is 20% and payout ratio is 60%. Payout ratio 60% means company paying 60%. When I say payout is 60%, that means retention is 40%. Question has purposefully not told you what is the retention ratio. It is saying payout. Paying 60% means retaining how much? 40%. So 40% into 20% is the growth. Okay, 40% into 20% is the growth. This also you can understand. Here you see this slide, last line, you see 40% into 20%. That means 20% of 40%, this becomes 8% is the growth. Okay, you can understand it with the help of example. Suppose you have a opening balance of 100, you are earning 20, and you are paying dividend 60%, payout ratio 60%. Okay, that means retention is 40%, you are retaining 8 rupees. 20 you are earning, paying 12, and retaining 8 rupees. Next year, the opening balance will become 108 because 100 rupees was opening balance plus your retention is 8 rupees, 108. 108 again, it is earning 20% means 21.6 you are earning. 60% we are paying means 12.96 you are paying, 8.64 you are retaining. Next year, your opening balance will be 116.64 because 108 plus 8.64. That will give you earning of 23.2 and you will be paying dividends of 40. If you see the dividend is growing from 12, it becomes 12.96. From 12.96, it becomes 14%. 12 rupees 12 dividend is going to 12.96. That represents 8% growth. Okay. And by applying this formula, we'll be also computing that 8%. That is B into R. Retention ratio is 40%. Our return on equity is 20%. 20% of 40%, it comes to 8%. So you know the cost of equity is U1 by P0 plus G, but if growth is not given, you will be able to compute growth rate by using these three formulae. One, simple average past growth. Two, point-to-point growth rate. Point-to-point growth in dividend. Third, by applying this formula, growth is equal to retention ratio into return on equity. Here is a question. Dividend per share is expected to be rupee 1 next year and grow 6% per annum perpetually. Market price of share is 25. Calculate cost of equity. Very, very simple question. What we are going to do? We'll compute like this. Cost of equity is equal to D1 by P0 plus G. D1 is 1 rupee. Price today is 25 rupees. Growth is given to in the question 6%, which means 0.06. And it gives us the figure that the cost of equity is equal to 10%. Hope you understood this. Here is one more question. Expected future growth rate of dividend is negative 5%. Growth rate is negative. Dividend today is 10. So future dividend will be less 5%. That is 9.5. So dividend today is 10 per share. Current market price is 50. Calculate cost of equity. Fantastic. Once you have understood the question, you will be able to do it. You see the answer. D1 by P0. Dividend today is 10, but what is the future dividend? Considering negative growth, it will be 9.5. Divided by P0. Okay, plus G. It comes to 14%. Okay, plus G, you see, here growth is negative. So plus minus G. So it becomes 9.5 divided by 50 minus 0.05. That is a trick in the question. Purpose plate is given, that growth rate is negative. Okay, here this gives us an idea that current dividend is irrelevant, future dividend is more important. Future dividend is 9.5 and that to growth rate is negative. So you'll be able to compute cost of equity by using this formula. Okay, friends, there are other methods also, but today we'll stop here. Okay, we'll stop here. The all other methods we're going to learn in our next class. Thank you very much. Thanks a lot.